Okay, questions, reflections on this? Yeah.
Just to get a sense on the consecutive picture of growth going forward, it just struck me when I looked at the first chart that you showed today that it wasn't a double dip in the US or Euro area, but it was sort of a pronounced downturn in consecutive growth terms. But in Sweden it was sort of a straight line. I haven't done the numbers here, I should have, but it seems to me like you revised down in consecutive terms after the strong number in the Euro area and in the US growth going forward compared to the last time. And how much impression has been made in the Swedish forecast there? Have you revised down the consecutive growth term to sort of, is that reflected in Swedish outlook?
Should I try? I think there are various things going on here. I mean, all things being equal, there's certainly a negative impact from the US coming into Sweden. But then the picture in the euro area is a bit tricky, with Germany having a really strong outcome. And that, as you can see, and as you said rightly in our forecast, is being interpreted to some extent as being a temporary effect, and we expect things to evolve calmer in the future, and that very much is related to the fiscal consolidation that is needed in the euro area. And so in the short run, in a sense, that has a positive effect on Sweden, all things else being equal. But there's also an important adjustment to the Swedish forecast that comes from the outcome in Sweden, where we've been surprised by strong exports, also investment turning up earlier than expected. So, I mean, all of these things come together into the Swedish path. I mean, I could look up now exactly how we've been revising the consecutive numbers, but I don't think that's the point. But I mean, it's a complex interaction between various forces here. But on balance, then, of course, Swedish output is revised upwards compared to last time.
But another sort of reflection here is to say that it's not unreasonable that the Swedish growth numbers are higher than some of the other ones here, because basically what happened this time was that we were reasonably balanced when all these things happened. Because we haven't had a fiscal problem, we don't have a debt to GDP problem when it comes to the public sector, and we don't have a domestic problem in the financial sector either. And that means that what has happened here is a very large exogenous shock, basically coming from all of a sudden demand disappearing in the rest of the world. But if you compare it to a number of other countries, then in their case, they have to struggle with high debt ratios. They have to struggle with working off bad loans and all those things that you have to do in your own economy, if your own economy happens to be quite unbalanced. And if you add to that things bounce back quicker in a small open economy compared to in a very large economy, then we feel actually quite comfortable with these numbers and these assumptions that we have made looking into the future.
Another important adjustment in your report is you do about labor market output gap and wage development. And I guess that you have been influenced by the recent labor force surveys regarding working hours, and also the recent statistics regarding the wage development. However, it's summer month, and the statistics are very, very uncertain. Might be revised up or down. What's your view about how certain you are about your new forecast, and can you evaluate the uncertainties going forward?
You are always certain about our forecasts. They don't. Yeah, they don't include some sort of variables added, kind of reflecting the degree of uncertainty. I mean, this is the best forecast that we can make, and then all sorts of things always happen in the world. But we don't grade our forecasts in that way. There's always uncertainty around in one form or the other, and that's just the nature of forecasting, and we just have to live just have to live with that. We're talking about the labor market. I mean, one interesting reflection, though, is that it's easier today, actually, to look at these issues compared to, let's say, a year ago or 2 years ago, because back then, basically, the experience we had was the experience from the 90s, our own experience from the 90s. And we know then that what happened in the labor market in the 90s was quite different compared to what has happened now. And a very major issue then, looking back, was to sort of try to understand, is this going to be the 90s or something else? And clearly now, when we look at the graphs, it wasn't the 90s for us. And that's very, very comforting when it comes to sort of thinking about how the Swedish economy works and what has happened here. That's not at all saying that there aren't uncertainties when it comes to the labor market. But if you just look at the graph, it looks more like kind of what we have observed in the past 10 years in one form or the other. And that makes it sort of easier to think about and understand compared to saying that here we have something completely different that we have never ever seen before. What we had not seen before was the very large drop in global demand. But then to translate that into what's going to go on in the labor market and how long it will take before the Swedish economy is going to bounce back, that's easier to see today compared to in the past, and that's comforting. But that's not saying that there aren't always issues when it comes to doing projections.
If I just can add maybe some specifics there about the labor market. I mean, I would personally feel rather confident when it comes to the productivity trend, let's say in a 2-3 years perspective or something like this. I mean, we've revised down, of course, productivity due to the strong development in the labor market, but I mean, that would be a trend that picks up. I think that there I would feel rather certain. I mean, otherwise we're in a completely different world, so that's, I think, hard to make generally forecast that would look very different. And then in terms of wages, I mean, at least for a few years ahead, I would also be confident that those are not derailing now in the short run. I mean, they may pick up a bit because of the stronger economy, and we indeed revise up our wage forecast slightly for that reason. But I mean, I wouldn't see any mechanism that make them derail in the shorter perspective. Then, of course, new wage negotiations will come into play, and there are some challenges there. I mean, there are some issues about structure in the wage negotiations that are a challenge. But in that sense also, I think, I mean, basically unit labor costs are sort of in place for the couple of 2-3 years ahead or something like this. That would be sort of my take on this.
It says in your report that the risk for your assessment of the risk of deflation in the U.S. is very low. Is that yes because of the growth in the U.S., or is it your trust in the Fed's ability to fight deflation?
It's a combination. It's a combination. And also one needs to be mindful of the fact, as I said earlier, that this has now been going on for 3 years, more than 3 years. And if you look at sort of the experience that you get out of looking at what has happened in a number of countries over the years, when you run into these kind of difficulties, is first, you can never make these problems disappear. Second, they do disappear after a while if you keep at it. And that almost independent of economic policy. It's a drawn-out process. And that's, of course, an issue in itself. Then how do we design economic policy in such a way that it doesn't end up being such a drawn-out process? But that's the way things appear to be, and now this has been going on for quite a while already, and that means that sooner or later house prices have dropped enough for this thing to get going again. Sooner or later the deleveraging has taken place to such an extent that actually gradually demand comes back. And then based on all of this, we have come to the conclusion that as far as we can judge, which is quite similar actually to the way many others look at it, growth will be there. But of course the numbers aren't that high, but definitely not on the negative side. Yeah.
The big difference between the Riksbank's repo rate forecast and the market expectations, that translates, I mean, further out, even beyond the 3-year horizon. It's getting very concrete effects in terms of lower lending rates for households and so on. So the stimulus that this puts into the economy is getting quite concrete. Is this something that could, going forward, have some effect on how you're setting interest rates? But, I mean, you don't mention it in today's decision, and you don't revise the path either. But is this something, if this discrepancy continues, or is it a matter of is the problem getting bigger as time goes on, or is it just something that you can put aside, or
well,
could it affect you to be forced, so to say, to hike rates a little bit more?
It's hard to look 5 years into the future. It's hard to look 3 years into the future. So it's not so easy to fully sort of reflect and fully understand what's going on if you look that far into the future. The issue here is that we have put together a consistent forecast. If you put in other numbers, if you put in other interest rate paths, you're going to have to conclude something very, very different about what's going on in the economy. And given the machinery that we use, we find that hard to do. Having said that, though, always when you sort of think about the future and when you think about the macroeconomy and where we are heading, then what matters, but that requires some deep reflections. It's not something that you do overnight, is to sort of think about, well, then, particularly when you do the modeling, what's your long-term equilibrium assumptions? And what would it take to change those assumptions? But that's not something that you kind of change overnight, saying that I'm feeling better about this number or that number. Because then basically when you construct the models, you have to have some kind of a foundation when you come to the conclusions about, let's say, the real rate of interest, what is normal growth, capital formation, and so on and so forth. And if you start looking sort of 5 years into the future, then we're really into those types of issues. How one sort of thinks about basically how the Swedish economy functions, and how you put these things together. So it's something that we're constantly working on. But I'm not ready today to say that the world has changed in such a way that the basic structure that we sort of have behind all of this in terms of doing the numbers has changed in such a way that something radically different would come out of it.